Merry Christmas, stackers. Looking at the spot price right now, the metal appears deceptively calm. It is flatlining. The paper charts are frozen, solid volatility has completely evaporated, and it feels like the riggers have finally clocked out for the year. But do not let that lull you into a false sense of security. That stillness is precisely what makes this setup so lethal for anyone holding paper contracts. Real markets do not just go silent because risk has vanished. They go silent when the spring is being coiled tight, compressing massive risk before the inevitable explosion. I am recording this update because tomorrow is critical for anyone paying attention to the real economy. December 26th marks the beginning of a window that professional manipulators understand instinctively, yet they rarely discuss it in the open. We call it Ghost Week. If you are stacking physical or trading paper and you do not understand what Ghost Week truly implies, you are about to walk blindly into one of the most fragile and manipulated environments of the entire calendar year. Ghost Week is not simply about low volume on the COMEX, it is about a complete lack of structural protection. The senior risk managers have left the building, the institutional desks that move the big fiat are shut down, the deep pools of liquidity that usually absorb shocks and keep the spot price somewhat tethered have vanished into thin air. What remains is a zombie market running purely on autopilot with dangerously thin liquidity and high-frequency algorithms designed to keep the exchange running, not to protect your wealth. When that liquidity drains away, the casino stops behaving rationally. Spot prices do not move smoothly or logically. They jump violently. They gap up and down. A single large order can inflict the damage of 100 normal trades. The chart might look peaceful right now because nothing has triggered the algorithms yet, not because the coast is clear. The lack of action is a mirage masking the lack of depth. Silver is not resting right now. It is being suffocated under pressure. Months of accumulated tension are packed into a market with absolutely zero depth. The most dangerous moment for a stacker is not during the panic, it is during the comfort. And this artificial comfort is exactly what this holiday silence manufactures. Do not mistake this calm for safety or stability. This is the eye of the storm before the volatility returns to wreck the shorts. In the next chapter, I will break down exactly how Ghost Week creates massive liquidity vacuums in the paper market and why silver specifically is uniquely vulnerable to violent moves when that silence finally breaks. Make sure to subscribe if you want to stay ahead of the next tamp down or breakout. Comment 1 to continue to. Chapter 2 or comment 2 if you want to stop here and stay in the dark. To truly grasp why Ghost Week is so treacherous, you need to understand one fundamental concept that most retail paper traders never figure out until it is too late. Liquidity is the market. It is not the news cycle. It is not the technical indicators. It is not the pundits' opinions. It is liquidity. When liquidity is deep, the market forgives your bad entries. When liquidity disappears, the market punishes every mistake instantly and ruthlessly. On a typical trading week, the spot price of silver is buffered by thick layers of paper orders. Thousands of buyers and sellers are stacked above and below the current price, creating a wall. If a whale dumps a large order, that depth absorbs the blow. The price might dip a few cents, maybe $1, but it stays controlled. This gives people a false sense of security. They think the market is naturally stable. It is not. It is artificially stabilized by the constant churning of paper participation and high-frequency trading bots. During Ghost Week, that participation completely evaporates. The bullion banks flatten their books. The hedge funds step away from their terminals. What is left in the order book is a tiny fraction of the normal depth. 70 and sometimes 90% of the liquidity just disappears. The walls that normally keep the price contained are quietly removed, while everyone else is distracted by the holidays and family dinners. This phenomenon creates what the pros call a liquidity vacuum. In a vacuum, the price does not travel normally. It falls or rises vertically until it hits a wall of resistance, and if there is no resistance, it keeps running. That is how you get air pockets in the chart. That is how the market can drop $4 or rip $5 higher without any warning signs or follow-through logic to support the move. And this is where the silver market becomes uniquely dangerous compared to gold or stocks. Silver is already an incredibly thin market compared to the S&P 500 or the Forex markets. It does not take much capital to move the needle under normal conditions. During Ghost Week, it takes almost zero capital to create a massive candle. A single institutional rebalance, a hedge fund covering their short exposure, or a rogue algorithm reacting to a news headline can push price levels to places that would be statistically impossible during a normal week. This is exactly why traders who rely on tight stop losses and heavy leverage get completely wiped out during these holiday weeks. The market does not trend against them gradually. It simply jumps right over their risk controls like they do not exist. Their stop loss does not protect them because the price never even traded at their number. It gapped right past it. Ghost Week is the moment when the markets reveal their true skeletal structure. There is no padding. There are no shock absorbers. It is just raw, unfiltered order flow screaming in an empty room. In the next chapter, we will look at why this vacuum works in both directions, how these massive gaps form on the chart, and why silver can rip violently higher just as easily as the cartel can flush it lower. A liquidity vacuum does not choose a direction. It is neutral. It does not care if the next move is a moonshot or a crash. It simply amplifies the force applied. That is what most people misunderstand. They assume the danger is only to the downside. In reality, the most violent damage to the shorts often comes from upside moves that happen too fast for them to cover. In a functioning market, price discovery is like a conversation. Buyers push, sellers respond, and the price negotiates its way up or down. During Ghost Week, that conversation goes silent. The sellers step away. The buyers hesitate. And when one side finally makes a move, there is nobody on the other side to slow the momentum down. This is exactly how gaps are born on the daily chart. It is not because of excitement or fundamentals, but because of absence. If a large buy order enters this thin market, the price does not climb tick by tick. It scans upward, desperately searching for the first seller willing to transact. If there is no one at the next level, it keeps skyrocketing. The result is a sudden vertical jump that looks irrational but is perfectly logical structurally. Silver is especially vulnerable to this type of behavior because of its dual nature. It sits at the intersection of critical industrial demand, monetary fear, and heavy speculative positioning. That means it reacts to more triggers than most assets: a war headline, a currency crash, a shift in bond yields. Any one of these can activate the buying programs. And during Ghost Week, those programs do not meet resistance. They meet thin air. This is why traders wake up and feel like the market skipped massive levels overnight. It did not skip them. Those levels simply never traded because there were no sellers present to take the other side of the trade. The danger is not just missing the move to the upside, it is being positioned against it with leverage with side. When the price gaps, your margin call does not negotiate. Stops do not trigger where you expect them to. Accounts are liquidated and closed out before logic can even catch up to the price action. And here is the key point most people miss. Upside gaps create massive psychological damage. They force late entries, emotional decisions, and panic buying from the FOMO crowd. That is how the strong hands transfer risk to the weak hands at the absolute worst possible moment. In the next chapter, we will connect this market structure to historical data and show why holiday weeks have repeatedly been the launchpad for silver's most explosive and memorable moves. If Ghost Week sounds like just a theory, history removes all doubt for us. Some of the most violent and trend-defining moves in silver history did not begin during busy trading weeks or headline-filled sessions. They began when everyone assumed nothing would happen. Holidays, thin volume, empty trading desks. That is where the pattern reveals itself every single time. Go back and look at Christmas 2010. Silver had already been rallying for months. Sentiment was stretched thin. Indicators were flashing overbought signals. The big banks were telling clients to take profits before the year ended. Most traders listened to the suits. They sold, shut down their screens, and went on vacation. During that quiet stretch between Christmas and New Year's, silver did not crash. It drifted higher. It started slowly at first, then built with growing confidence. When the traders returned in January, the price was already way beyond where they had exited. That quiet drift turned into panic chasing, and by April, silver was trading near $50 an ounce. The launchpad was not the rally itself. It was the silence of the holidays that allowed it to break free. The same structure appeared again in December 2020. The markets were thin. Participation was historically low. Silver was recovering from that major crash earlier in the year. During the holidays, positioning quietly shifted behind the scenes. Price began to creep higher without any resistance. By January, gaps appeared. Momentum accelerated. What looked like a dead zone became the ignition point for the run. This matters because markets do not repeat exact events. They repeat human and algorithmic behavior. When liquidity vanishes and the suppression mechanisms step away, silver naturally wants to rise. It requires constant effort and paper shorts to hold it down. When that effort pauses even briefly, the price expresses its true direction. But today's setup is not a carbon copy of 2010 or 2020. It is far more dangerous. Back then, the COMEX vaults were full. Inventories were deep. If price moved too far, the bullion banks could step in and absorb the move with metal. Today, that buffer is thinner than it has ever been in our lifetimes. History does not just warn us that Ghost Week matters. It warns us that when silver moves during the holidays, it tends to set the tone and the trend for the entire year that follows. In the next chapter, we will look at why this time is fundamentally different, what has changed structurally in the plumbing of the market, and why inventory levels matter more now than at any point in modern history. The critical difference this time comes down to one single word: inventory. In previous cycles, silver moved because of paper speculation. This cycle is moving because of physical scarcity, and that changes the entire game. When speculation drives a rally, it can be reversed by the bankers. When scarcity drives it, control is completely lost. In past bull markets, the vaults acted as shock absorbers. When the price surged, metal flowed into storage as holders took profits. Supply increased, pressure eased, and the market could reset. That mechanism no longer functions the same way. Instead of metal flowing into vaults at higher prices, it is draining out of them. And that is a structural warning signal that most paper traders are not prepared to understand. When registered inventory drops during all-time highs, it signals something highly abnormal is occurring. It means buyers are not interested in the price. They are interested in possession of the physical asset. These are not momentum traders or short-term speculators flipping contracts. These are entities securing supply because they no longer trust future availability. Once metal leaves the system, it cannot be rehypothecated. It cannot be used to cap the price. Once that physical metal leaves the vaults, it is gone forever, and no amount of paper promises can ever bring it back to suppress the true price discovery. Pros call this a concrete floor. It is structural support. Paper prices might flash crash, but physical buyers inhale that dip instantly. It is not about price anymore. It is about finding the metal. Toss Ghost Week into the mix. Liquidity evaporates just as the vault echoes. Dealers' naked shorting calls get wrecked when the physical dries up. They cannot dictate the spread, they just scramble. Enter the feedback loop from hell. Spikes force hedging, hedging drives spikes. With no physical silver to cool it down, the system cannibalizes itself. There is no off-ramp here. Traders misread the red candles. That drop is not weakness. It is the machine resetting. Paper hands sell out of fear only to realize the rig has left the station without them. Next, we link this physical drought to the paper casino. We will show how gamma squeezes flip a sleepy chart into a vertical god candle with zero notice. Physical stress bleeds into the paper game. Futures assume the silver exists. When the vaults are empty, the paper exchanges start chasing a physical reality they cannot manipulate anymore. Market makers sell calls assuming they can hedge later. Works fine until Ghost Week hits. With order books thin and metal gone, their safety net vanishes. Now they are exposed. Break a key strike and dealers must buy futures to stay delta neutral. This buying forces prices up, triggering more buying. A classic gamma squeeze driven by pure panic, not choice. Throw in the liquidity vacuum. Usually sellers absorb the shock. But now nobody is selling. Every forced buy sends the spot price vertical. It does not climb, it teleports. This is why holiday rips wreck accounts. Traders fear crashes, but squeezes are the real killers. They happen fast, ignore technicals, and lock the doors so shorts cannot escape. The algos pour gas on the fire. Programmed to chase volatility, these bots stop shorting and start buying the breakout. They do not care about value, they just ride the momentum wave. That green candle is not enthusiasm. It is the sound of the market breaking. The mechanism is not celebrating. It is snapping under the weight of naked shorts. Up next, we explain why your RSI indicators are useless trash right now. Relying on standard charts will have you selling your stack just before the real moonshot begins. Traders see familiar warning lights and think they should sell. Big mistake. In a broken market, those signals do not mean stop. They mean the brakes have failed completely. Oscillators work when buyers and sellers agree. When physical is gone, the negotiation ends. An overbought RSI is not a sell signal. It is a gauge of how much pressure is building. Check the history. In every monster run, silver pinned the RSI to the ceiling and kept it there. Shorting because of a chart line is not cautious. It is suicide against the structure. We are in price discovery mode. No resistance overhead. No bag holders looking to break even. With everyone in the green, the usual selling pressure just evaporates. When sellers vanish, dips are barely visible and rallies turn violent. The market does not ask for permission. It runs until a margin call or an exchange halt stops it. Breakout bots smell blood. Once new highs hit, they execute buy orders instantly. They do not care if silver looks pricey. They only care that it is moving. Trusting indicators during Ghost Week is a trap. A brief pause looks like a top and then price gaps up 10% while you are waiting for a re-entry. Coming up is Survival 101. How to ride this Ghost Week volatility without getting bucked off or blowing up your margin account. Forget predicting the top. Just survive the ride. Being right does not matter if a volatility spike wipes your account before the payoff. This is the Pro League now. When the order book is empty, precision dies. Price teleports dollars in seconds just because a buy order hit air. It feels crazy, but that is just thin market physics. Do not get cocky. The better the setup, the less leverage you need. Volatility is the admission fee. If you cannot handle the swings, you do not get the gains. Expect the Judas swing. Sharp instant drops designed to hunt stop losses. Over-leveraged longs get flushed and the market rips higher while they watch from the sidelines. Play small. Widen your stops. This is not the time to scalp for pennies. It is time to sit on your hands and let the structural shortage do the heavy lifting. Ignore the 1-minute candles. Watch the behavior. Survive the chaos. The real truth comes out when the big boys return to the desk. Next, the January Open. We will see if this move is just holiday fluff or the start of the big squeeze. Holiday charts lie. January speaks the truth. When full volume hits, we find out if this was a glitch or a total repricing of the metal. The first real session is the judge. When the hedge funds log back in, if silver holds the line or pumps on volume, it is game on. That means the move is real. Amateurs freeze up here. They want a pullback that never comes. A clean break with volume is not exhaustion. It is the market accepting a new price reality. Do not panic at the open. Early January loves a final shakeout. Watch the bounce. If buyers step in aggressively, that tells you everything you need to know. Fear turns to FOMO. Fund managers sitting in cash suddenly need exposure. If silver is the only horse running, they have to buy it to save their quarterly numbers. Stop guessing and start watching. Do dips get bought instantly? Does resistance turn into butter? That behavior screams continuation. In the finale, we stack all these clues together. We will turn this setup into a battle plan for the next few months. This is not business as usual. Ghost Week is the airlock. It is the pressure chamber where the physical shortage breaks the paper containment. Discipline is your only shield. The market does not care if you are right. It cares if you are solvent. Scarcity is real. But the ride to fair value will be violent. They will try to buck you off. Patience is the ultimate weapon. Do not chase green candles. Do not panic at red ones. High volatility is normal now. The only enemy in this room is your own leverage. Tune out the noise. Headlines are distractions. Watch the metal. If dips are bought and sellers are hiding, that is the only signal you need. Crucial point: know exactly where we stand in this debt cycle. Real asset bull markets don't end quietly. They don't top out when fear is high. They top when everyone rushes in. We aren't at that stage yet. This phase is strictly about recognizing the disconnect, watching the repricing, and positioning your stack for the wealth transfer. If you take one golden nugget from this series, make it this. You don't need to call every tamp down. You need to respect the trend, protect your ounces, and let the currency debasement do the work. The goal isn't trading paper contracts. The goal is to be holding physical when the manipulation breaks and real price discovery unfolds. If this helped you see through the fiat illusion, support the channel by smashing that like button, subscribing, and sharing with those who want sound money truth. Drop a comment on your current stack and stay sharp. The next big breakout is coming, and stacking weight early always beats chasing the high premiums later.